Hello, my fellow investors, and welcome back to another fundamental analysis video as well as earnings report analysis. Today, guys, we had a lot of companies report. However, the one that I'm mostly interested in is the one that you're looking at right here, because Waste Management, it is such an incredible company. I have been eyeing this company for so long, but man, the main problem is the fact that I have yet to find a good entry point for this company. And after today's earnings, I don't think it's going to happen anytime soon. So we're going to take a look at this company's earnings, of course. Then we're going to take a look at the company's fundamentals on a 5-year perspective, and then do a discounted free cash flow approach to see what price we should pay for this company, because, well, it's very, we'll take a look at the graph, but right now, for the past 3-4 months, this thing has just been going up non-stop. It's just absolute insanity. It's also a company that I have some cash secured puts on as well, and because of the massive rise, it's probably now getting crushed, which is really good to see too. So we're gonna take a look at that, guys, and of course, make sure to like, subscribe, comment. Really does help here on YouTube as well as Rumble, and of course, make sure to follow us on X. Now, before we go actually into the company, I also want to point out, guys, that February 14th, Ash Wednesday or Valentine's Day, we are officially going to start live streaming exclusively to Rumble. Okay, so if you guys would like to see that, we're going to cover mainly CPI, or honestly the CPI, and we're also going to take a look at earnings maybe that we had, or even from the days prior. So if you guys would like to see that, we're going to be exclusively on Rumble. Link is in the description below, and I can't wait to see you guys there. We have a great opportunity because we won the Rumble partnership. So if you guys would like to see that, make sure to follow us there and check us out on the Rumble too. You do not need an account if you want to see us, just you can't really comment if you don't have an account. But with that said, guys, let's get started with this analysis. Okay, everybody, so let's get started with this. However, I'm pretty sure you guys are seeing something a little bit different in that I'm actually pulling up an article from Seeking Alpha because, well, as of literally like a few minutes ago, I bought Seeking Alpha Premium because I figured, you know what, we're getting the Rumble partnership, we're going to be doing this, we want to make this a company, we want to give you guys the most amount of value when it comes to investing, so we're gonna need to do a little bit of investing on our side for the channel. So I bought Seeking Alpha, and on top of that, I'm actually gonna be changing the calculator up a little bit because now I actually have 10 years of data, so I can actually make a 10-year analysis now based on this kind of free cash flow. So that's just a little bit of an update right there. So let's take a look at this. Waste Management stock rises on earnings beat dividend hike. Yes, guys, absolutely crushed it. Take a look at this. Waste Management's stock rose 4.4% in extended trading after the trash collection company, love it, reported a profit that beat estimates amid improvements in pricing and volume. The company's board also raised a yearly dividend, that's a typo, from $2.80 to a whopping $3 per share. Net income was $493 million, or $1.22 a share in the fourth quarter, compared with $499 million or $1.21 per share a year earlier. So they did go up by a penny on an EPS perspective. Adjusted earnings of $1.74 a share beat the average estimate amongst Wall Street analysts of $1.53 a share. Nice. Revenue rose 5.7% from a year earlier to $5.22 billion in the 3-month period ended December 31st. The results were in line with the $5.2 billion forecast by analysts. Quote, in 2024, we anticipated our financial performance to be driven by disciplined pricing, enhanced operational efficiencies, prudent cost management, and contributions from our investments in our recycling and renewable energy businesses, said Jim Fish, president and CEO of Waste Management, said in this statement. Management forecasts revenue growth of 6 to 7% for the full year of 2024. That's insane. Wow. So what is that? 1%, well, 0.3% more on the lower end than what they did this year. And adjusted operating earnings before interest, taxes, depreciation, and amortization, EBITDA, basically, of $6.28 billion to $6.43 billion. Now, guys, the one thing I do have to mention is the fact that, yes, Waste Management approves a 7.1% dividend hike and a $1.5 billion buyback in 2024. Now, this article is from December of 2023, but it still applies to today because if you own this company, you just got a 7.1% boost, which that is actually really solid. So you went from 70 cents to 75 cents per share, or as we saw, $2.80 to $3. So let us jump into now their earnings. Now, we pretty much read all of this. However, I would like to show you all the tables so that way it looks a little bit better. Looking at the year ended, you guys could see that December 31st, 2023, 2023, 20.4 billion as opposed to December 31st, 2022, 19.7 billion on a revenue basis. Income from operations, we are now at 3.6 and before we were at 3.4. Operating EBITDA is now 5.65 and before it was 5.4. Operating EBITDA margin 27.6 and before it was 27.4. Net income is currently 2.3 and before it was 2.24, and diluted EPS of $5.66. It was before $5.39. Looking at what the CEO had to say, let me increase this for you guys a little bit. I may not be able to. I'm so sorry for that. Well, actually, yes, I can. We got, quote, our operating and financial results in the second half of 2023 surpassed expectations, driven by strong execution in our pricing and operational excellence programs. Our teams continues to make progress in optimizing our cost structure and our investments in people, technology, assets, accelerated margin expansion ahead of plan in the fourth quarter, said Jim Fish. During the fourth quarter, our collection of disposal business performance powered the total company's adjusted operating EBITDA growth of 15% and recorded adjusted margin of almost 30%. Our performance in 2023, particularly the momentum built during the second half of the year, positions us well to sustain growth throughout 2024. Absolutely crazy. Now, looking at the highlights though for 2023 right here, we got the company grew revenue at 3.7% due to primarily core prices, driven primarily by core prices of 7%. Revenue growth from the core prices and volume finished the year ahead of expectations. Collections and disposal yields was 5.4% and collection and disposal volumes increased 0.7 or 0.9% on a work day adjusted basis. Operating expenses as a percentage of revenue improved 70 basis points to 61.7%, driven by efficiencies in the collection of disposal businesses. SG&A expenses were 9.4% of revenue compared to the 9.8 or 9.6 in adjusted basis in 2022. The company adjusted operating EBITDA grew 7% to 5.9 billion. Operating EBITDA in the collection and disposal businesses grew 457 million to 6.63 billion. Absolutely crazy. Net cash provided by operating activities increased 4% to 4.72 billion, and free cash flow before investments in the high return sustainability projects grew 5.1%, guys, to $2.67 billion. Total company's free cash flow, including investment and sustainability projects, declined 3.7% to 1.9 billion. That is something that I noticed when it comes to the free cash flow. Well, that's the worst one, but I do have an explanation for it. Looking now into the 2024 outlook, take a look at this. The company revenue is expected to grow 6 to 7%. We already saw this. The company's disciplined pricing programs are expected to result in the core prices between 6 and 6.5%, and collection and disposal yielding approaching 5%. Collection and disposal volumes growth is expected to approach 1%. Total company adjusted operating EBITDA is expected to be in the range of $6.43 billion, an increase of about $450 million at the midpoint of the range, which includes about $115 million of adjusted operating EBITDA growth from sustainability growth investments. Adjusted operating EBITDA margin is expected to be in the range of 29% to 29.4%, expected 30 basis points at the midpoint of the range. Now, what I'm mostly interested in is as well this free cash flow allocation, because this does actually tell us why the free cash flow is falling. And well, we can pretty much see it right here in the first bullet. WM expects to spend in the range of $2.2 to $2.3 billion in capital expenditures to support this normal business activity. Wow. Okay. WM intends to invest between 850 to 900 million for capital expenditures on high return growth projects in its recycling and renewable energy businesses. I actually really do like this because I will show you guys the CapEx on Seeking Alpha, and it is this. So it's interesting because when you think about CapEx, you would normally think, okay, they're mainly reinvesting it into themselves. In this case, they're actually telling us that no, this is just for normal business activities. So normal business activities have increased, which is honestly okay, I guess. Continuing on, free cash flow before these targeted sustainabilities and automation focused capital investments is projected to be between 2.75 to 2.9 billion. Free cash flow is projected to be between 1.9 to 2.05 billion dollars. Right, and that is also regarding this 2.2 to 2.3 capital expenditures. WM's cash flow outlook and strong balance sheet position the company to continue its commitment to sound capital allocation. The company plans to invest 100 to 200 million in solid waste acquisitions. Okay, the board of directors has indicated its intention to increase the annual dividends by 20 cents. We already saw this, increasing estimated annual dividends paid to shareholders to 1.2 billion. I love this. I absolutely love this. This will be the 21st consecutive year of the increase in the company's per share dividend. Each individual future quarterly dividend will be declared at the discretion of the board of directors prior to the payment. In December 2023, the board of directors refreshed the company's share repurchase authorization. Great, because if they're increasing that dividend, they need to buy back those shares, providing for the repurchase of up to $1.5 billion in the company's common stock. WM expects to repurchase $1 billion of its common stock in 2024. So that pretty much does it when it comes to the earnings. The link will be in the description below for you guys to read the rest of it if you so wish to do so. Highly encouraged. Now, it's actually interesting because even though they are planning to repurchase $1 billion, yeah, I would really appreciate it, guys, if they didn't do that right now, because you're looking at this 52-week range, 148.31 to 190.44. Just today alone, we already saw it, 4.4. It has come down. Guys, after market, after earnings, 3.12%. I don't know what else to say about this, right? This thing, I mean, if we take a look at this, ever since October 2nd, this thing has just been on a crazy uptrend. And if we take a look at the year to date, this thing is up already 5.11%. 5-year range, look at this. From COVID, this thing hit a COVID low of, if I can get it, $87.87. Oh my goodness, if you bought into this company right now, you would be printing money at this point. We'll see what the calculator says, though I highly think that based off of that free cash flow, I don't think we're going to get too good of numbers here, but we'll see regardless. But we shall go over this regardless. So let's jump into the calculator. We got the ticker for WM, market cap of 76 billion, a PE of 33.27, a whopping share price of, I believe this is near all-time highs, actually, $188.26. They do pay out a dividend of $2.80. However, this isn't correct. This should be at $3 per share, as we read over here. So let's change that, guys, to a solid $3, okay? And if we come back over here, we can see that, well, okay, this isn't updated, but with a annual payout of $2.80, this is a yield of 1.5%. Really tiny yield. Payout ratio of 47.83. A 5-year CAGR of 3.37, which is also really small. However, 4 years of dividend growth, I don't think that's correct. They said 21. I don't know why, but Seeking Alpha is not getting this right. If we take a look at the dividend history, this goes, I mean, if we take a look at the 10-year, this goes well past the 5-year mark, guys. I mean, I don't know what to say with this. I think it's just not updated correctly. So no, it's 21 consecutive years, so they're almost a dividend aristocrat. Ex-dividend date passed as of November 30th. Payout date was on December 15th, and they pay their dividends quarterly, so most likely their next payout will be very soon. Looking back at the spreadsheet, with this $3 in annual dividends and their current shares outstanding, they pay out $1.21 billion. If we subtract this from the 5-year average free cash flow, this is left with $767.8 million, and so the last year's free cash is $462.6 million. These payout ratios aren't the best. The 5-year average looks better than the last year's at 61.15, and the last year's looking 72.32. Again, this is mainly due to the fact that their free cash flow is actually decreasing, believe it or not. Let's now jump into the 5-year perspectives on these fundamentals. So starting off, we got the net income, guys. 5 years ago of 1.67 billion to 1 year ago of 2.3 billion, increase of 38%. Aside from COVID, this is a straight line up. I'm going to give this 100%. The free cash flow, this is where things begin to hurt a little bit, because we got 5 years ago of 2.1 billion to 1 year ago of 1.67 billion. That is a decrease of 19%. And this is an average of almost $2 billion. So we already saw as to where the capex is going to, and $2 billion worth, guys, is going back to just normal company operations. And if we take a look at this overall cash from operations and capital expenditures, we can see that, yeah, on the trailing 12 months, look at this, $2.715 billion in capital expenditures. However, take a look at this, though. This isn't updated, but the cash from operations is also increasing at a decent amount as well, as you guys can see over here. So yeah, it's a little bit strange. If adding CapEx increases their cash from operations, then it shouldn't be much of a problem. However, it is still a decrease on the cash flow. I'm going to give this an overall grade, guys, of 60%. Looking now at the revenue, this looks absolutely perfect. Aside from COVID, which dipped a little bit, this is increasing at a whopping 32.16, going from 5 years ago of 15.45 billion to 1 year ago of 20.43 billion. I'm going to give this, guys, 100%. The assets minus the liabilities is stagnant. However, it's not necessarily bad. I wish it was increasing, but it is what it is. Average total assets being 30.74 billion, liabilities of 23.66 billion, a difference of $7.1 billion. I'm going to give this guys a solid 70%. Now the cash flow minus the liabilities, well, you can see that they were kind of sustaining right here, 5, 4, and 3, and then they came crashing down to the 1 year ago. Their cash flow fell, and the 1 year ago value being negative 23.3 billion, the average being negative 21 billion. Yeah, guys, I'm gonna have to give this a 60%. The reason is because this is due to the fact that their cash flow is decreasing, but we know why it's decreasing is for basic company operations. Looking at now, guys, the shares outstanding, this is looking absolutely perfect. In fact, the one time that they increased shares, it was actually in 2019 where they increased it by 0.3. So not really much of an issue there. Consistent buyback, as you guys can see right over here, going from 424.3 million to 1 year ago, i.e. 2023, of $402.8 million. This is looking insane. This is a buyback of 5.07%, essentially 1% per year. And previously to the current year, a buyback of 1.25%. This is a solid, guys, 100%. And on top of that, we just read that they are going to continue to buy back shares. So this is still 100%. This is great. This is absolutely great. And lastly, looking at the cash and equivalents, they currently hold $150 million with an average of $814 million. Overall, great for this company, guys. I'm going to give this an 83. Biggest concern here is the free cash flow, but we know why based off of their earnings report. So now the problem is, what price do you pay for this thing? Because we're near all-time highs, if not already there. And for the past 4 months, this thing has just been going straight up. So here we go. This is where I'm going to start to lose people because these numbers aren't going to look good. So looking at now, guys, the discounted free cash flow portion right off the bat, $72.49, not adjusting for debt, and adjusting for debt, well, 35 bucks. Okay, this is where I'm going to lose people because a lot of you are going to say, this is stupid. Like, why would you listen to this? Because if you wait till it falls down to $72.49, which it will never do, by the way. I mean, it's not like other companies haven't done that. Check Generac, by the way, right? You will just miss on the entirety of their overall growth in the past 4 months. I mean, what I have to say to that is basically go find other companies that are fair value. I'm all about, guys, buying into companies that are fair valuation. And I look at this, and right off the bat, it's not fair valued. So we could input in some numbers, but just FYI that based off of this, the numbers aren't really going to go up that much. So let's input the overall projected share buyback assumptions in the form of 5% for the median, since that's what they have been doing. Let's go to 4, and then let's go to 6%. Now for the revenue. Seeking Alpha actually has this thing at 6.45%. Like I say, I actually do believe this, seeing that this is a very boring company, which I love. So let's actually input that, guys, and let's put in the revenue growth assumptions around 6%. Then let's go to, remember, this is in the next 5 years. Pretty soon we'll be able to do one that's in the next 10 years, which is going to be crazy. So we got 6%. We got over here. Then let's put like 7. Yeah, and then let's go to 8%. Guys, I mean, $93.15 to $101.76, adjusting for debt, $54.04 to $61.85. Margin of safety of 5, 10, and 15. This is $45.94, so 46 basically, and $59. Now, you guys are looking at this, and again, you guys are like, no way, this thing just went up that much, there's just no way. Well, understand that every investment is the present value of all of your cash flow. I mean, you could say in the next 5 years, their revenue is going to grow 10%, right? 10%, then let's go to 12, and then let's go to 14. And if we do this, look at that. Now that becomes $124 on the peak. And let's just say for some reason, you want your required rate of return to be lower, let's just say 7%, which is the lowest for the S&P 500. Oh, look at that. It now becomes a buy. So it really just depends as to what numbers you input here based off of your own assumptions, because every investment is the present value of all future cash flow. Looking at this is an all-out buy right now, right? Based off of not adjusting for debt and slightly overpriced when it comes to adjusting for debt, but still not too bad. I see this, and could they do that? Maybe, honestly, perhaps. I don't know. This might be something that I want to talk with Mike in trying to become less conservative when it comes to these kinds of companies. However, when it comes to waste management, because they are very boring, they're very stable, this is not a growth-related company, I'm going to push these percentages down a little bit more. So this is my assumptions, guys. Of course, this calculator, guys, is available for free. So go in the description, and you guys can find it there and make your own assumptions for yourselves, because this is not financial advice. And if we take a look at this dividend at the current share price, guys, this nets you $91.23 if you input $5,725. So that pretty much does it, guys, for this analysis. You know, I see it as very expensive, but for me, I might just wait on this, see if it falls. If not, then I'll just buy into other companies that are fair valuation for me. So yeah, make your own assumptions. And with that said, guys, make sure to like, subscribe, comment. Really does help with the algorithm on YouTube as well as Rumble. Of course, make sure to follow us on X. Remember that on Wednesday, February 14th, Ash Wednesday and Valentine's Day, we will be having our first Rumble live stream exclusive since we got the partnership for Rumble. So if you guys would like to see that, and we'll talk about, you know, the CPI, earnings, and all that stuff, you guys can follow us there. So with that said, peace out, and we'll see you all tomorrow on the live stream since you guys are seeing this on Tuesday.